Hi, I'm ReAnn Gonzalez with Edge Home Finance, and today we are going to talk about what's the difference between a consumer credit score and a mortgage credit score. Before we get into it, do me a favor and hit the like and subscribe button below. Okay, so now let's get into it. I have clients call me every week that are confident they know their credit score. 9 out of 10 times, they are looking at a consumer credit score that is provided by their credit card company or Credit Karma, My Free Credit Report, Experian, and others. These scores are perfect for a credit card application or even an auto loan, but those scores are not the same as what we use on the mortgage transactions. We use a different credit scoring model than consumers have access to, which means we may see a different credit score than you expect. Now, don't get me wrong, Credit Karma, My Free Credit Report, these are great tools to use and monitor your credit with, but not to qualify or price a mortgage interest rate. And that's because consumer credit scores and mortgage credit scores are calculated differently. Typically, what I see is our mortgage credit score is about 25 to 30 points lower than a consumer credit score. You have to realize we are lending much more money than a credit card company or auto loan. Many consumers do not realize that you don't just have one credit score, instead you have hundreds of potential credit scores at any given time. Your credit scores will differ depending on the following items. The credit report used during their calculation. Credit scores are calculated using the information contained within your credit reports. You have a credit report from each of the major credit bureaus, Equifax, Experian, and TransUnion. Each of these credit reports may differ slightly since they receive information from your lenders at different times. The other is credit scoring models. Another crucial factor is the credit scoring model used to calculate your credit score. FICO and VantageScore are the most popular credit scoring models used in the United States. There are several versions of these two credit scoring models, as well as hundreds of others from additional companies. Each credit scoring model weighs various aspects of your credit activity slightly different. Lenders typically use product-specific credit scoring models. As a result, we as your mortgage lender use a different credit scoring model for your mortgage application than what will be used for your auto loan or credit card application. Here's how they differ. Your mortgage credit score is likely FICO, a score created by Fair Isaac and Company. Over 90% of lenders use this credit scoring model from all three credit bureaus, TransUnion, Equifax, and Experian. The credit scores range from 300 to 850, with 850 being the highest credit score. Mortgage credit scores put a lot of emphasis on payment history and credit utilization, with other factors playing a role too. 35% is payment history. Your payment history tracks how well you make your payments. Any payment made 30 days or more past the due date hurts your credit score, whereas a timely payment history can greatly improve your credit score. 30% is credit utilization. Your credit utilization is a comparison of your total outstanding debt compared to your credit lines. For example, if you have a $1,000 credit line and you have $500 outstanding, you have a 50% credit utilization rate. Ideally, you should keep your credit utilization rate lower than 30% for the best results. 15% is credit length. The age of your credit cards affects your credit score too. The older your credit is, the better it is for your credit score. Don't close old accounts unless it's absolutely necessary, as this is an easy way to increase your credit score. 10% is credit mix. Lenders like to see that you can handle a variety of debt, including credit cards, which is your revolving debt, and installment debt, which is your mortgage loans, personal loans, car loans, etc. 10% is inquiries. Each time you apply for new credit or take out new credit, it slightly influences your credit score. Consumer credit scores, also known as educational scores, are credit scores that can be accessed by consumers. Typically, consumer credit scores only use information from one of the credit bureaus. Additionally, they're calculated using consumer scoring models rather than mortgage credit scoring models. Vantage 3.0 is the most common credit scoring model used for educational purposes. With this credit scoring model, your credit activity is weighed according to the following percentages: 40% payment history, 21% age and type of credit accounts, 20% credit utilization, 11% account balances, 5% recent credit applications, and lastly, 3% available credit. As you can see, your payment history plays the largest role in both your mortgage and consumer credit score. You must make your payments on time. From there, the differences begin with credit utilization, a major factor in lenders' decisions since too much outstanding debt can make it hard to afford a new mortgage. Mortgage credit scores focus mainly on your payment history, credit utilization, and credit mix. This is how we determine you are a good risk and can afford the mortgage payment you're applying for. Even if you have a good consumer credit score, don't assume your mortgage credit score will be the same. I always recommend that a client wanting to buy in the next 3 to 6 months reach out to me so I can do a soft credit report pull and let me look at the mortgage score and report to see if there is anything we need to work on. I hope you found this information helpful. If you know of anyone who could use some credit advice or have questions about mortgages, please share my YouTube channel with them, as my goal is to help as many people as I can achieve the American dream of homeownership. And credit is a major part. Lastly, if you have any questions and want to chat about your situation, please feel free to reach out to me at 915-478-1157 or apply at my link listed below. Thanks and have a great day. Bye.